All right, let's get a review of this year's reporting season. It's, well, coming to an end. There's still a few companies set to report, but we're pretty much through the bulk of it. Marcus Bogdan from Blackmore Capital joins us live via Skype in Melbourne. Marcus, pleasure as always to have you on the show. I guess the place to start is your summary of reporting season. We've been hearing from a lot of guests that, it's probably more hits than misses in terms of what we've seen. Would you agree with that? Expectations were pretty low to start with, though.
Yes, broadly, yes. I think expectations were low. We were expecting anywhere between 20 or 25% reduction in earnings per share, and it came in at around 20% down. But I think it's the mix which was really interesting, and I think, and that's why you had more upgrades than downgrades. The breadth of more positive results, better than expected, that was what surprised me, and it was pleasing to see it. Yes, we had all of the social distancing impact on those companies, and the destruction in earnings and dividends was profound. But there were a really broad group of companies that did particularly well through this earnings season. But I guess the next step is obviously the guidance and how we track into FY21.
Have you made many changes, I guess, to portfolio structure after or during reporting season, or does it tend to be post-reporting season, when you get time to really dig deep into all the numbers, compare all the stocks to each other when really the hard work starts?
Yeah, no, look, the debriefing afterwards and the closer attention to the results is where we would make the most of our changes. I mean, there were some pleasing results prima facie, particularly things like Cleanaway and CSL, which we'd look to increase over time. And then on the disappointment side, it was things like Telstra, where the forward guidance there and the future returns looks lower than anticipated.
Let's through Cleanaway in a bit more detail then. This is one that, as you say, you liked. It's an industry that I imagine is pretty recession-proof, pretty much COVID-proof. Would you agree with that? And is this part of the reason why you like the business?
Yeah, absolutely. But we're also concerned going into that result that it does have a very large exposure to SMEs, about 180,000 customers. Yeah. The liquid waste business is somewhat cyclical, but the broad business of collections held up incredibly well, particularly in residential. It was very good cost outs by the businesses. They achieved their synergies with the Tox acquisition, and they made a very good acquisition of SKM for a very distressed price. So net, the business was more resilient than we anticipated. The cash flows were stronger, and they were able to also deliver margin improvement.
Does it interest you, I guess, we did see some insider selling in terms of the stock. I guess there's always a bit of a concern when you see the CEO and MD sell down some of the stock. I think it ended up amounting to about 73% of their holding. Look, people are allowed to take profits, of course, but, does it come as maybe it's the top of the stock?
Well, you've had an incredible reaction to the result, and now it is up to sort of fair value. So from a longer term perspective, we think that the metrics around the vertically integrated waste industry look particularly pleasing. But yes, as you know, we always look at what insiders are doing. Yeah. But I think that's just an inevitable path through the process.
Give us a bit more colour on healthcare. CSL, I mean, a lot of investors love CSL. You're also looking at Ramsay Healthcare quite closely. Compare the two for us and let us know your views on these.
Sure. Well, both have been affected by COVID. Mm-hmm. CSL was less impacted than we initially thought. Some of those impacts will be coming in this financial year, but the company did particularly well in navigating the downturn, particularly in plasma, where plasma collections in the US were down 20 to 30% at its trough. They've started to recover now, but offsetting that, very, very strong vaccine business, particularly in influenza, and unsurprisingly, they've sold out in Australia and now for the Northern Hemisphere winter. So Still constructive on CSL, believe that they can grow earnings in FY21. You contrast that to Ramsay, which was really deeply affected by the reduction of elective surgery in Australia and in all of the jurisdictions, the UK and France in particular. But the pent-up demand for elective surgery will be extraordinary. One statistic in the UK, which is a major market for them, there's now 50,000 people on the waiting list in the UK waiting for more than 1 year to get their procedure done. That compares to 2,000 people a year ago. So you can see the next 18 months to two years, very, very strong demand, and I think once we get through this COVID, very good utilisation in their hospitals. So for both of them, we like them for different reasons, and they're both core stocks in the portfolio.
Consumer staples. Look, this has been an interesting space because, you'd think perhaps a bit recession-proof, COVID-proof, maybe even riding some tailwinds from, I guess, some of the changes that have happened during COVID. But then at the same time, extra costs associated. There's, a lot of things going on with these Coles, Woolies, Wesfarmers. What is your take on these particular stocks? And do you have a favourite out of the three?
Yeah, well, we actually own all three through the entire period. I think Woolworths demonstrated that it is the absolutely quality pick in that sector, particularly in supermarkets. What they're seeing in this financial year and the growth rates there are particularly encouraging. I think longer term, they're doing some very good work on automisation and their distribution channels there. Wesfarmers, again, extraordinarily strong result, particularly in Bunnings and Office Works. And so for the moment, they have defensive characteristics, but they're still growing quite well. And so we would still see them as core parts of the portfolio.
Yeah, it's interesting because I wonder as well with some of these stocks going forward whether the coronavirus has actually accelerated their need to sort of keep up with structural changes, such as investing. I know Woolworths has invested in some supply chain businesses just recently, just in the last few weeks. You've got e-commerce becoming more and more important. They're streamlining those operations and doing a lot better with things like delivery in light of what's happened with COVID. This is stuff that actually needed to happen for these businesses anyway. So do you see this as just accelerating what needed to happen?
Absolutely. I mean, you have seen the incredible pickup on online grocery sales, and the supermarkets dominate that space, but they don't make much of an earnings at the moment. And so what they're doing in terms of getting better supply chains, better distribution, so that they can bring that margin of their online business up over time to hopefully match what they achieve in their physical stores.
Finally, just to wrap it up, News Corp. I know this is another one you've been watching, the media space more broadly. Where does it stand?
Well, I think both News and Nine performed a lot better than people anticipated. The move into digital, into subscriptions, was particularly encouraging, and I think news is about the catalyst to create future value. We look at it in some of the parts, and we see within the business very, very good businesses which they could crystallise much better value, particularly in digital property with REA and Move, and also other businesses such as Dow Jones. And so for that reason, we remain positive on that stock.
All right. We will leave it there with you. We really appreciate your time, Marcus, as always. Thank you.
Thanks very much, Ingrid. Cheers.
Great wrap up of reporting season there from Marcus Bogdan.